Hi, I'm Richard Murphy, and this is the 24th in the video series on the importance of tax transparency that I am hosting, and which is being made jointly by the University of Sheffield, where I work as Professor of Accounting Practice, the Global Initiative for Fiscal Transparency, and the International Budget Partnership. In this video, we are looking at how the advanced and aspirational tax transparency principles published by the Global Initiative for Fiscal Transparency should influence any jurisdiction's tax transparency agenda. The GIFT transparency principles for tax policy and administration, which were adopted in 2022, were designed to address a gap in the current tax debate, the lack of consensus around what constitutes revenue transparency and how best to promote public participation in decisions regarding taxation by identifying the information and tools needed to promote strong civil society engagement in tax policy and administration. The principles are split into 4 types: basic, intermediate, advanced, and aspirational. There is some overlap between these groups, but the obvious reason for structuring the principles in this way is to make clear that progress towards tax transparency is achieved in stages. There is no excuse for not starting that journey. Achievements can be marked along the way. The final destination is aspirational in the sense that no tax authority has yet reached it. We have already discussed the basic and intermediate tax transparency principles in this video series, most recently in video 23. In this video, we will be looking at the advanced and aspirational tax transparency principles. There are 4 of these, numbered 11 to 14. Some are considered to overlap with the intermediate principles, but as with all the principles, they represent stages on the journey towards tax transparency on which we think all countries, governments, and tax authorities should be engaged. From the outset, I make clear that the principles discussed in this video are as they are described. All of them are advanced. 1 or 2 are aspirational. They represent the way in which we think the tax transparency agenda should develop, if it is to deliver on its potential to improve the well-being of all people in the countries which embrace the importance of this idea. If these ideas are unfamiliar, please don't worry in that case. We are promoting them to encourage the process of change that will, we hope, deliver the levels of tax transparency we think are desirable in the future. The first of the advanced tax transparency principles is GIFT Principle 11, which says, governments should evaluate and report on the extent to which taxes that are legally owed go unpaid, as a first step in preparing a tax gap estimate, which is also referred to in Principle 14. Tax transparency is ultimately a means to increase confidence and trust in tax systems, and with it tax morale as indication of the willingness to pay tax. This can be aided by discovering the extent to which taxes go unpaid due to illegal tax evasion, legal but ethically questionable tax avoidance, and because revenue authorities fail to recover taxes declared but unpaid. Tax gap analysis, which estimates the difference between potential and actual tax revenues, offers insights into unpaid taxes, tax evasion, tax avoidance, and tax policy gaps, and can help identify how much tax is not paid and why. Some jurisdictions, like the UK and EU, publish tax gap estimates, though methodologies vary. Transparency deters tax evasion by exposing practices like underreporting income and tax avoidance by highlighting the use of tax loopholes. Publishing detailed data improves accountability, fosters trust, and guides resource allocation for better tax compliance. That is why this process matters. It is also why we look at it again in more detail in later videos in this series. Tax Transparency Principle 12 suggests that governments should seek to examine the impact of and publish information on the amount, sectors and beneficiaries of tax incentives, such as reliefs, allowances and exemptions, in terms of their rationales, costs, benefits and effectiveness. Tax reliefs, allowances and exemptions significantly impact public revenue and are often disputed or are used as the basis for tax avoidance activity. Research in the UK suggests that more than 1/3 of its tax revenues are foregone by granting tax reliefs, allowances and exemptions each year. This does not mean that they are wrong, but it does mean that they need to be understood. And around the world, there is little discussion on the cost of these reliefs. Enhancing tax transparency requires accurate reporting of revenue foregone, identifying beneficiaries, and the clear rationales for each relief. This includes assessing costs, benefits, and impacts in a comprehensive annual report. Open reporting fosters public understanding and debate, counters perceptions of favouritism, encourages evaluation of relief's rationale and impact, enhances accountability, ensuring reliefs serve societal goals effectively, while addressing suspicions of hidden welfare for select groups. Tax Transparency Principle 13 suggests that the data underpinning tax transparency should be subject to verification by an independent agency that audits, evaluates, and reports on the accuracy, quality, and fairness of that data. Tax transparency requires reliable, quality-controlled data to ensure accuracy and prevent contradictions with other sources. Adopting tax transparency standards enhances appraisal processes and prevents data manipulation for political purposes. Ensuring data integrity may involve independent expert panels representing diverse interested parties such as academics, campaigners, and tax professionals. Effective safeguards include robust oversight mechanisms, inclusive perspectives, and rigorous scrutiny procedures. The degree of transparency depends on the safeguards in place, the extent of review processes, the diversity of viewpoints involved, and the level of diligence in ensuring data reliability. The benefit of all this is in an increase in tax morale, and so in tax likely to be paid. The only aspirational gift tax transparency principle is number 14, which suggests that governments should aspire to work with international bodies to periodically evaluate the performance of their tax system by applying advanced assessment tools, such as tax gap analyses and tax spillover assessments, to enhance their own and stakeholder understandings of the risks and vulnerabilities within the tax system and to inform potential reform debates. The principle emphasizes achieving this gold standard of tax transparency to improve tax systems. Central to this are tax gap analyses and tax spillover assessments. Both are essential for identifying revenue losses, their causes, and their sources. Tax gap analysis estimates the difference between potential and actual tax revenue using various methodologies. Governments are encouraged to collaborate with experts, international organizations, and civil society to perform these analyses, which inform policies for optimizing tax collection. Tax spillovers refer to unintended effects of tax policies that undermine tax systems domestically or internationally, resulting in reduced revenues or weakened tax administrative processes. These are influenced by tax competition and other policies, making qualitative assessments necessary alongside quantitative estimates. Spillover assessments should seek to highlight administrative weaknesses and behaviours that compromise the tax base, providing a comprehensive review of tax system performance. An ideal spillover assessment combines quantitative and qualitative elements, utilising a standardised methodology. This approach benefits multiple interested parties, including revenue agencies, governments, opposition groups, and the public. Key outcomes include identifying weaknesses in tax law enforcement, noting ways to improve fiscal management, finding better ways to assess tax compliance, and high-level evaluation of tax authority performance. Spillover assessments also reveal vulnerabilities to international tax competition, enabling targeted reforms without raising tax rates. They should become the gold standard appraisal methodology for governments seeking to deliver tax transparency to maximize their chance of making the best possible recoveries of tax due to them. In summary, these principles are intended to raise the quality of tax management in any jurisdiction, increase the level of tax transparency in a jurisdiction, inform best quality tax decision-making, raise tax morale, deliver the tax revenues governments desire, and enhance social outcomes from tax systems by ensuring that everyone pays the taxes that they owe. This is why we focus on them in the remaining videos in this series.